Okay, so we are going to do exercise 9.9 on page 941 in the book. And this on the screen right here is showing you kind of the process we go through to figure things out. Part of the processes, I should say. All right, so problem 9.9 says, Theo Company has delivery equipment that costs $50,000 and has been depreciated $24,000. Instructions. Record entries for the disposal under the following assumptions. A, it was scrapped as having no value. B, it was sold for $37,000. And C, it was sold for $20,000. All right, so those are the three scenarios. And then they say to us, where's the instructions? Oh, instructions, record the entries. Okay, so here we go. So the very first thing, well, let's do this. I'm going to put it up here on the screen. I'm going to do, this is A. So A was where it was scrapped for no value. Okay, scrapped for no value was scenario A. So we have to first figure the annual depreciation. Okay, first thing we have to do is figure the annual depreciation, right? So this is figuring the annual depreciation here, all right? So I'm going to put here figure annual depreciation. Okay. So we're going to start with the cost. So the cost of the asset they told us was $50,000, right? The asset cost is $50,000. So we have an asset of $50,000. I'm going to, $50,000 cost, less any salvage. And this problem didn't give us any salvage, right? So since there was no salvage available, then we are going to go, we take cost minus the salvage value, and that's going to give us $50,000. Okay. And $50,000 is what they call the book value, or no, not the book value, sorry, depreciated costs or base. They can call it either of those one of those two things, depreciated cost or depreciated base. Okay. Now what we're going to do, we take the depreciated cost and we're going to divide it by the useful life. Okay. So in this case, we have $50,000 divided by, oh, and you know what I just realized? They did not give us any useful life in any of these problems. None of them. None of them. So you know what that means? If they don't give you the useful life, you cannot figure out the annual depreciation. If you cannot figure out the annual depreciation, you cannot ask yourself, is depreciation current? Because you don't know how much it is. There's no dates. You don't know when it was bought, right? So you can't figure out any of that. You can't do number 1, number 2, or number 3. So you have to just assume everything's current and go to number 4. So this makes this a super easy problem, which it's not going to be that easy all the time, but we're going to go with it. So I'm taking all that out there. We don't have to do 1, 2, or 3. Okay, so for A, for all these problems, okay, so for all of these, I'll put here, all of these problems, no dates means depreciation is current. The assumption means the assumption is depreciation is current. Because you can't, there's nothing you can figure out. So we will go to step 4. All right. So going to step 4, how do we do it? So we have, we're going down here to number 4, down here on the bottom in blue. Okay. So we have the cost. So in this case, our cost is $50,000. The accumulated depreciation in A, they tell us, or what do they tell us in the problem? The accumulated depreciation or the asset has been depreciated $24,000. So less depreciation, less accumulated depreciation, $24,000. So that means we take $50,000 minus $24,000, and that gives us a book value. Oops, it gives us a book value of $26,000. Okay. So we have our book value of $26,000. So we take the book value, $26,000. We then are going to list the proceeds. My brain went dead there for a minute. Proceeds, 0. So in this case, the book value is 26,000. The proceeds are 0. So the difference is 26,000, right? So the rule tells us if the proceeds are less than the book value, we have a loss. So we have a loss of $26,000. So basically we threw away a piece of equipment worth $26,000 is what happened for this. So in order to do this entry, we have no cash involved because we weren't paid any cash. We just salvaged it. We took it to a scrapyard. So we are going to debit accumulated depreciation equipment, and we're debiting that for the $24,000 to get rid of that. We are then going to debit loss on disposal of plant asset. I'm gonna have to make this column bigger. Loss on disposal of plant asset, and the loss is $26,000. And then we are going to credit equipment for the cost of the equipment, which was $50,000. So this first one here, A, is disposal of a plant asset with no proceeds and a loss. So disposal of plant assets with no proceeds and a loss. So that's A. So we're going to go over to the next column here and we'll do B. So I'm just going to copy over the process that we go through here. Right there. So we're going to start with the cost. The cost is $50,000 because it's the same problem, but we have a little bit of difference with when we dispose it. Less accumulated depreciation of $24,000. That gives us a book value of $26,000, right? So we have the book value of $26,000. What are the proceeds in B? So in B, they tell us that the proceeds are $37,000. $37,000. So that means we got $37,000 cash. And the rule tells us that if the proceeds or the cash is more than the book value, we have a gain. So the difference between the $37,000 and the $26,000 is $11,000. And we're calling that a gain because we got more money than what the asset was worth. We sold an asset for more than it was worth. Okay. So we're going to go down here. And when we have a gain, when we sell it for proceeds, cash is always the first thing we deal with. So we got cash. So we're going to debit cash for the amount of cash we got, which was $37,000. We are then going to debit accumulated depreciation equipment to clear out that account. And accumulated depreciation equipment for this one was $24,000. We then have to get rid of the asset. So we are going to credit the asset account, equipment, and that's for $50,000. And then we are going to credit gain on disposal of plant and asset. And the gain was $11,000. Okay, so that is an example of the disposal of a plant assets for proceeds that were more than the book value, which resulted in a gain on disposal of plant assets. Resulted in a gain on disposal and plant assets. Okay, so now we're going to move over a little bit and we're going to do C. And I'm assuming C is going to be a loss. Because we've done one that's a wash or break even. We've done one that's a gain. And now let's look at the next one. So we have the same cost of $50,000. We have the accumulated depreciation of $24,000. This gives us a book value of $26,000. In this one, the proceeds are $20,000. So the proceeds are $20,000. So we have a book value of $26,000. We have proceeds or cash of $20,000. So that means the proceeds are less than the book value. So we have a loss of $6,000. So this is a loss on disposal of plant assets. All right, so when we have a loss on disposal of plant assets, we are going to debit cash for the amount of cash that we got. In this case, we got $20,000. We are then going to debit accumulated depreciation equipment for the amount of the accumulated depreciation, which is $24,000, to clear that account out. We are then going to debit for loss on disposal of plant asset. And the loss that we figured out was $6,000. And then we are going to credit for equipment to clear out that account and get that asset off of our books, which was $50,000. Okay. Okay, so this is an example of a problem where we did not have to bring the depreciation current. They didn't give us information for depreciation. So what we did is we did just the math and the entries for the disposal of the plant asset. The first one was disposal for no proceeds, so it ended up being a loss. The next one was disposal for proceeds that were more than the book value, so it was a gain. And the next one was proceeds or disposal with proceeds for less than the book value, so it was a loss.